Hi, this is Merrill with Tax Tutor. Today we'll be talking about maybe something that could be considered kind of a controversial topic. I have a different take, a different perspective when it comes to retirement accounts than maybe other people do, but we'll get into that here shortly. I've been a CPA for 20 years. I've been preparing tax returns for clients and helping clients with tax strategies and tax savings. There's clients we've helped save $1 million or more, clients we've saved hundreds of thousands, and so yeah, we kind of run the gamut on helping people save money on taxes. And like I said, today we wanted to talk about retirement plans and kind of my take on them. It's I guess kind of difficult to say, but is what happens is you can save money by putting money into a retirement plan. So a lot of CPAs and a lot of financial advisors will kind of come and say, hey, put money into your 401k, put money into your SEP, put money into your IRA, your traditional IRA, and look at how much tax we're saving you. This is amazing, this is great, we're doing a good job, yay, right? So I tend to take a different perspective, a different look on that. Yes, you can save money by putting money into a retirement account, but I see the other side of that. We have a lot of clients. I have clients that are in retirement that have for years socked away their money into their retirement accounts, got their deductions when that went in, saved their money on taxes when it went in, and now they're retired, and guess what? All that money is now taxable to them. They now have to pull that out and pay taxes on it. And do you know what happens? Is that it increases their adjusted gross income, and when your adjusted gross income increases, the money that you pay on your Social Security income also increases, meaning it makes more of your Social Security taxable. So there are clients that we have, if they weren't required, so that's the other huge downside of these retirement accounts, is that if you live basically kind of too long or to a certain age, and that age changes, but if you live to a certain age, they require you to take money out of it. It's called a required minimum distribution. So it's a forced distribution out, which forces you to pay tax on the money. You no longer have control over when you can pull that money out and pay tax. They're forcing you, and if you don't do it, the penalties are crazy. Like you lose a ton of money that way. I want to say the penalties are like half of what you would normally pay, or half of what you were required to take out. They'll just take that as a penalty. So they force you to take the money out. They force you to pay tax on it. And that ends up pushing your AGI, your adjusted gross income, higher, which then makes your Social Security more taxable and has a bunch of other negative effects. And so, yes, it's great to get a deduction now, but you have no idea the train wreck that's coming years down the road. And let's say that maybe you get to that required minimum distribution stage and you've got to pull it out. Let's say you don't make it to that required minimum distribution stage. Let's say that you pass away before that, or even if you pass away with any amount in that retirement account and pass it on to your heirs, guess what? That is called income in respect of a decedent, which means it was income that you were supposed to be taxed on during your lifetime, but since you passed away and went on, and didn't pay that tax, whoever gets that account, they're now responsible for the tax. So now, instead of you paying the tax and taking care of it, your heirs are going to pay the tax and take care of it. Now, your heirs, depending on who they are and what tax bracket and situation they're in, they could actually end up paying more tax on that inherited retirement account than you would have paid had you just taken it out. And so that's why I kind of have a negative view toward these retirement accounts sometimes, is that, yeah, the tax advisors and people telling you to get into it, they look great because they're saving you money on tax now, but the 20, 30, or whenever it is that you retire, are they going to be around then to kind of take responsibility for the deductions that they told you to take back here, and now you've got to recognize all this taxable income? Like a really bad scenario that we ran into was that somebody had passed away, the retirement accounts went down to the kids of one of our clients, and those kids then had to take that money out, and there's a kiddie tax that comes on that, so the kids had to pay tax at the parents' level. It ended up taxing them on a really high percentage, when they're just kids, they're just children. And so you're not solving any problems by passing away with a retirement account, you're just creating problems for the people that inherit that. So anyway, there are some better options out there. They don't give you a deduction now, but they don't cause tax problems for you later. The chief one among those is a Roth account. Anytime you can get money into a Roth account, yes, you're going to pay tax on that money now that goes into there, but you know what? That will grow tax-free. So let's say that you put $100,000 into a Roth account over your life, or let's just say it's a regular retirement account. Let's say $100,000 into a traditional retirement account. By the time you retire, it's all been invested and all done really well. It's not uncommon for that to go a crazy amount. Let's say it's up to $500,000. Well, you only put $100,000 in, you've got deductions on that, now it's grown to $500,000. You are taxed on that entire $500,000 as you pull that out of the account. And as that continues to grow, you're constantly taxed on that. Let's take the reverse into account. Let's say that you have a Roth account that you put $100,000 into over the course of your life, and that's now grown to $500,000. Well, since you paid tax on that $100,000 you went into and you have a Roth account, the growth to $500,000, the growth to $500,000 is not taxable. You can actually pull $500,000 out of that Roth account once you reach age 59 and a half or older. You can pull that whole $500,000 out and pay zero tax on it. So being taxed, having $500,000 of cash that you're not taxed on, in my mind, is way better than having $500,000 of tax that I'm fully going to be taxed on that I only got a $100,000 deduction for when it went in to begin with. So Roth accounts are great ways to avoid running into that train wreck of taxes when you retire. There is another option, and this one can tend to be a little more controversial, but is a strategy and helpful altogether, and that is looking at life insurance accounts, cash value life insurance accounts. So some people, you can fund Roths, and it's important to do that. I'd say that's probably your primary, is get Roths funded and all that. But if you've got extra cash, a place to park it, a place to put it, putting money into a life insurance, a cash value life insurance, and letting that grow in value, if you fund those, and I'm not a life insurance expert, so I'm not going to go too much into the details, but I understand the basics of how it works, is that you can set up these plans where you fund it, you put money into that life insurance. It builds a cash value if you have the right type of life insurance. It builds a cash value, and when you get into retirement, that cash value, you can actually borrow against it. Rather than cashing out that life insurance and ending that policy and getting the cash out, you can just borrow against it. And as you borrow against it, that loans are not taxable to you. So you can actually borrow against it, get the cash from that, take advantage of that value that's sitting in there and not have to pay any tax on it. A lot of kind of advanced strategies will call this what's called the buy, borrow, die strategy, where in this case you buy life insurance, you borrow against it, and then when you die, currently in the tax code there's a step up in basis, so you get the step up, and another strategy is that the life insurance portion of that then covers the loan that's in there and takes care of it. That's generally more commonly what happens, is that you just keep that policy till you die. The cash value covers the loan against it, and you've had use of that tax-free. So those are a couple of better options: Roth accounts and perhaps a cash value life insurance if, again, you've got a lot of cash and need a place to put it. That can be a place to put it. Of course, talk with financial advisors, talk with professionals that know those plans, specifically the life insurance accounts. Those can be complicated. And so yeah, have someone on that. With a Roth account, those are great. The other great thing about Roths is that you can self-direct the investments in those. Like a life insurance, usually are not able to self-direct it because they have very specific things that they have to invest in to make sure they're getting the right returns on there. But with a Roth account, you can have a self-directed, which means you can go out and buy rental properties, you can go and buy businesses, you can buy certain things. Well, maybe not businesses, but yeah, you have to be careful on what you buy. But yeah, certainly rental properties and other appreciating assets can be purchased through a Roth account. And so those are some options there. If you want to have more tax strategies and tax options, make sure you subscribe to our channel and go to taxtutor.com. You can sign up for our newsletter where we'll send out tax tips and strategies on a weekly basis.